You're listening to a CNA podcast. Hey, this is Andrea Heng, and I'm back with the Money Talks podcast, where we specialize in talking about money. More importantly, all the things you can do with it. So in the previous episode, we looked at how to add resilience to our investment portfolio, especially with a looming recession, that dreaded R word. Go check out that episode on Spotify or Apple Podcasts, will you? Now, our episode today focuses on a bigger, longer-term investment, owning a second property. It's especially appealing to couples, for example, who can choose to take advantage of two income streams and turn it into another income generator by owning two properties, right? But decoupling has also become a bit of a hot-button issue, especially with the new ABSD, that's the Additional Buyer's Stamp Duty, and that was announced in April of 20% for Singaporeans buying a second property. Now, some of you might be wondering, what's decoupling? We'll get into that later, trust me. So, is two truly better than one? What should we consider before taking the plunge? And should we start thinking of a second property as a form of inheritance for kids? Let's take a look at some of our options now with Clive Chng of Redbrick Mortgage Advisory. Thank you for joining us on the Money Talks podcast, Clive.
Thank you for having me.
So, Clive, in your line of work, how many people have you encountered owning a second property?
Actually, quite a few.
Oh,
Out of 10 inquiries, private property owners, maybe you get 30-40% of them.
wow, that's a
thinking
pretty
about
sizable amount.
thinking about owning a second property. So whenever someone has cash or they've gotten a windfall from their work through bonuses, the immediate thing they always think about is, I want to own a second property and be a landlord.
Yeah, exactly. Okay, so what then become their biggest financial concerns when they're
Right.
considering buying that second property?
Yep. It's always a matter of getting the proper financing and trying to avoid as much tax as possible, trying to
yes.
make the purchase as streamlined as possible. So when we're talking about buying a second property in Singapore today, obviously additional buyer's stamp duty becomes a large topic because, like you mentioned earlier, it was revised to 20%.
Yeah.
So if you're purchasing $1 million property and you have to pay $200,000 of additional buyer's stamp duty, that really burns a hole in your pocket.
Oh, yeah.
So couples are always thinking of ways to try to make their purchases more efficient. And that's where you mentioned rightly where this thing called decoupling comes into the picture. Perhaps let me explain a little bit more about that.
Yeah.
So decoupling is a process where, for example, husband and wife owns a private property and now they want to own another one. So the husband purchases over the wife's share.
Right.
Or vice versa, leaving the wife propertyless.
Right.
So now that you don't own a property, you purchase your own private property, you won't have to pay for additional buyer's stamp duty.
Right.
Yeah, so if you're a Singaporean citizen and you're buying your first property, there's no additional buyer's stamp duty
Okay,
at all.
and do they tend to be married couples? Do singles do this? Or I guess parent and child do
Yeah,
that
it
as
can
well?
be in any form of configuration. Most commonly, they're usually husband and wife. Yeah. But yeah, I've seen quite a few cases as well where it's a parent and a child or even between two friends. There are no restrictions to who can decouple.
Okay, before anything else, I believe there are questions that we need to ask ourselves, as usual, as part of our homework when considering buying a second property. I think it's best to think about it in three ways, okay? Affordability, intent, and eligibility. So let's talk about the first one. And arguably, it's the most important, affordability, right? What aspects of our financial health do we need to look at to determine if we can, in fact, afford a second home? Basically, also, what should our financial threshold be, for example?
Yep. So MAS and the banks have put in regulations to prevent someone from over-leveraging. Now, on the topic of affordability, commitments are usually the biggest thing that we think about, right? How much you spend on your credit cards, whether you own a car or multiple cars, whether you have personal loans, all these commitments greatly impact the amount of loan you can actually obtain from the banks when you're looking to purchase a property.
That's right.
So affordability, if you're looking to purchase a property, you would want to always make sure that you keep your commitments to, a low. right? Make sure they're in check. Make sure there are no late payments. You don't default on any payments because...
So that's what you mean by loan, not necessarily volume, but just making sure you pay your bills on time.
Yeah, I mean, volume does come into play as well because
Sure.
if I have a car and the monthly installments in the car is like $3,000 a month, that is going to substantially bring down your loan eligibility, right? And if you also make late payments, that would show up. So whenever the banks determine your loan eligibility, they would always run a credit bureau search. That basically gives an indication to the bank of your repayment history.
Right.
So if you've been late on certain credit cards for like 30 or 60 days, doesn't look too good.
Yeah.
And because of that, they may impose some stricter conditions. Like instead of being able to grant you the maximum of 75% loan, they'll probably say, I'll grant you 60%.
Right. What about thinking about time frames? I mean, I don't want to be servicing a home loan well into my 70s and my 80s as well, right? Isn't that something to consider as well?
Yeah. Well, the cap today, I mean, if you're an investor, you would actually think a little bit differently. You won't mind serving the loan until you're like at the age of 75, for example. And here's why. So when someone buys a property today, the banks would always grant you a loan tenure up to the age of 65. So for example, if I'm 50 years old, I'll get a 15-year loan tenure.
Okay.
Right? Some people get even imagine I'm 60 years old, for example, extreme case. My loan tenure is 5 years. And because the loan tenure is 5 years, my monthly installments tend to be quite high, right? And that eats a lot into my cash flow. So some people will be like, hey, Clive, I actually want to get a longer loan tenure, you know?
Right.
Because if I can extend my loan tenure by 10 years, from 5 to 15 years, the commitments drop by more than 50%.
Yeah, and it doesn't hurt your cash flow.
Yeah, so it's better for me because the cash that I save can potentially be reinvested into something that gives me a better return.
Exactly.
Right. So there are a lot of considerations when, deciding on how much loan you want to take, how much CPF you want to use, how long of a loan tenure you would like to take. Really depends on the requirements at that point of time. But the good thing is that, you get to review your mortgage portfolio every 2 or 3 years.
That's
It's
right.
necessary. And you can always make some changes along the way in terms of like your loan tenure, or if you're looking to make a lump sum repayment, you can actually
basically
do so as well.
refinance the mortgage.
Exactly.
Okay.
You have a lot of flexibility when you refinance your mortgage.
Okay. So there are also certain laws and regulations that we need to consider when working out affordability. Of course, I'm going to bring into the picture now the new ABSD, and we have to think about that in mind. There's something in there about the ABSD involved in the transference of property into a living trust. Okay, you need to average man this out for me, Clive.
Okay. So now, let me start off by saying, recently the government has introduced this thing called an ABSD trust. So if you're buying a property under trust, you would have to pay for the additional buyer stamp duty of 35%.
Oh, it's even higher.
Yeah, it's 35% now.
Okay.
So let's rewind this a little bit.
Sure.
If I don't want to have to pay for additional buyer stamp duty when I, buy multiple properties, one of the ways of acquiring properties is through my sons and my daughters. Right?
Of course, being of legal adult age.
You don't have to be.
Oh, you
Not
don't?
necessarily.
Okay.
I can even set up a trust for my kid who is 3 years old.
Oh, wow.
Right?
Okay.
Now, here's the thing. When you buy a property under trust for someone who is a minor, the property, number one, you can't take a loan on the property. The property has to be fully paid for in cash.
Wow.
Okay. Let's assume a property purchase price of $1 million. So you buy $1 million in cash. On top of that, the government will charge you 35% additional buyer stamp duty. Now, is there a way to get this 35% back? Yes, there is a way. Now, why is there even a 35% additional buyer stamp duty? Let's talk about that for a moment. Everyone likes to find loopholes when it comes to investing in the property market.
Absolutely.
And in the past, there have been people who have bought properties under their kid's name, under trust. And when the property has appreciated in its value, they sell off the property when it's actually meant for the kid.
Right.
So they purchase a property for an investment under the disguise that I would like to buy this for my kid in future.
And that's perfectly legal.
In the past.
Okay.
So, of course, it's going to be a problem because, you get a lot of rich Singaporeans or even PRs or foreigners snapping up properties because they have a lot of cash and then just flipping it when the time is right. So now the government, because of this, has imposed this 35%. Okay, if you want to do this, you pay an additional buyer stamp duty of 35%.
I mean, if you can afford $1 million in cash, you can afford another $350K.
Yeah, you might be right, but I mean, when it comes to that level,
Do you think it's been effective though.
It has.
Okay.
It has. So paying another 35%, and we're not talking about like, $1 million purchase. Usually the purchases tend to be a bit larger.
Of course.
2, 3, 4
a
million.
million is a conservative number,
Exactly. And paying 35% of that is going to be painful, right? So they've put in place this additional buyer's stamp duty, but there is a way of getting it back, provided that you fulfill certain requirements, right? So the requirements, for example, would be, you cannot sell the property. You cannot be the one selling off the property. The property has to be left for your kid, right? You cannot put in any additional clauses saying that, I still have the power to sell away the property, for example.
Because it's technically not yours.
Yeah, exactly. So I won't go into the real technical details.
Sure.
I think that can be found online as well. But yeah, certain requirements have been set up to ensure that you are just legitimately buying this property and leaving it for your kid and not any other funny business.
Okay.
So if you can prove that that's the case, you will get your 35% back.
Wow. Talk to us also about the taxes involved and using CPF for your second property.
Yeah, okay, great. So now assuming that I intend to hold the first property and continue to purchase the second property. So it's a second property that I'm going to own under my own name. Now, number one, if I have an existing mortgage on property number one, and now I'm looking to get a mortgage on property number two, the maximum loan the banks will grant me is only 45%, right? So we have to take note of that.
Yep.
Whereas when you buy a first property, you can get a maximum loan of 75%. So that's additional cash that you have to come up with. That's number one. Number two, if I intend to use CPF on the second property, and I have already used CPF on the first property.
Right.
There's a limitation as to how much CPF I can actually use, right?
Okay.
I have to set aside and make sure that I have the basic retirement sum
That's right.
in the OA and the SA combined, and anything in excess of that, I can then deploy in my second property.
Because it's technically seen as an investment. You would do the same with your investment monies, right? In your CPF.
Yeah.
Okay.
That's
okay.
right. So when it comes to buying a second property, you would realize because of the lower loan to valuation and the lower amount of CPF usage, you tend to have to come up with a lot of cash.
Yes.
Adding on to that, besides your regular buyer's stamp duty, you would have to pay for additional buyer's stamp duty as well.
That 20%.
If you're Singaporean, it gets higher if you're a PR or a foreigner, definitely.
We
But
remember
20%
that
is like the
number.
lowest already in the second property.
Yeah.
So you would have to fork out quite a fair bit of cash, you realize, on that second property itself, right? So, and that's the reason why, people are embarking on, if they have an opportunity, to decouple on the property.
Right. Okay, that makes a whole lot of sense now.
Yeah, but if you're a single owner and you're looking to purchase a second one, I'm sorry. I mean, those are the options. Either if you're looking to, leverage at the maximum loan, because sometimes if I own a condo under my sole name,
Yes.
and let's say I've been owning it for a few years now,
Right.
my outstanding loan might have come down quite a fair bit.
Right.
I may consider just paying off the loan on my first property so that on property number two, I can leverage at 75%.
Got it.
Yeah, correct.
That's a
So-
smart move. So another financial assessment that we need to think about is thresholds because, property here is notoriously expensive and all those really strict rules and regulations and limitations that you were just talking about. So second homes are not always attainable to many of us. So what should our financial threshold be in the first place?
Okay, so let's talk about eligibility, right? Whenever you purchase a property, let's talk about a private property, you immediately get subjected to this thing called the total debt servicing ratio,
That's
the
correct.
TDSR, right? Simply put it, your total commitments cannot exceed 55% of your total income.
Okay.
So for instance, if I'm earning $10,000 a month, my entire liabilities, including the property or whatever car loans or personal loans I have, cannot exceed $5,500,
Yes.
right?
Yes.
So if I'm looking to buy a second property and I already have an existing mortgage, that eats into my 55%.
Of course, yeah.
And let's say I only have $1,000 left, right, to be able to obtain a mortgage, I would realize that I actually can't borrow much from the banks.
Yeah, it's not a lot.
Yeah, so either I have a lot of cash, to throw into the property, or because my loan is small, or I embark of maybe purchasing commercial properties instead.
Oh,
Because
okay,
commercial
interesting.
properties, the regulations are a little bit different as compared to residential properties. You still can get 70 or 75% loan if you own a residential property and you're looking to buy a commercial property.
Uh-huh.
And commercial properties doesn't come with additional buyer stamp duty.
Oh,
Yeah.
interesting.
So
Okay.
that's usually when you have an investor who has maximized their residential portfolio, then you would realize they start moving into the commercial space as well.
Okay, so that brings us to our next consideration, intent.
Yeah.
So, what questions do we need to ask ourselves with regard to the purpose, the objective, the goal of buying a second property? Is passive income the only reason worth doing it?
Well, that's usually the first thing that people think about. But we always have to remember, yes, you are a landlord, your tenant is paying you, but you have to make your monthly mortgage payments. So if your monthly mortgage payments are $5,000 and your tenant is paying you $5,500, your passive income is $500 a month. And we haven't also considered property taxes,
Yes.
maintenance fees, for
Yep,
example. So
yep.
you might end up with a negative cash flow, even though you're a landlord. So that's not the only thing that one would consider when purchasing a second property to get passive income. We're also looking at capital appreciation.
Okay.
Right? You buy a property now, or you buy a property when it's new. After 5 years, most probably the property is appreciated in its value.
Yep.
And then you sell, and then you realize the returns after that. And if you get a positive cash flow on your tenancy, great. Right? Good for you. That's a bonus. But you're not just going to ride off how much you're getting in terms of your rental.
Correct.
And just bank on that in making an investment decision. You always want a greater upside. So that's the
Sure.
other upside, capital appreciation. And I mean, if you're owning a property in Singapore, chances are the property would retain its value. You wouldn't see property prices just come crashing down.
Yeah.
So to many people, that is like a safe bet. If as compared to putting my monies into the equities market
Yeah.
and the cryptocurrency market, so that's a different thing altogether. But yeah, I think that's the consideration. The intent cannot just be purely I just want to get passive income,
Right.
but you're thinking longer term, 5 years, 7 years.
What are you
going to
do with that asset?
Yeah, if I'm going to dispose of that asset, how much am I going to get in return, right? And if you annualize it, am I getting 2-3% per annum, or am I able to get 6-7%?
Yeah.
Because if I'm only going to get 2-3%, I may be better off also trying to diversify and put my monies into different investments.
Exactly. I mean, from what you're saying, it really feels as if we need to look at it as we look at any portfolio
Yeah.
asset in there.
Hello, my name is Steve Lai,
And I'm Teresa Tang, and we are the hosts of CNA Correspondent.
a podcast that takes you to the heart of the work our correspondents do across the globe.
From China's COVID response to the childcare center massacre in Thailand.
And from the fall of Najib Razak to the rise of Anwar Ibrahim as Malaysia's Prime Minister.
We speak to the people at the reporting front lines.
So if you want to know how the biggest global stories unfold, make sure you follow or subscribe to us wherever you get your podcasts.
Okay, so here's what I understand. Some people say that you can afford to and want to leave your child with an inheritance. It's best to buy a second home now while prices are relatively within reach. What do we need to know before we secure property for our children? Well, we touched on this briefly from the trust point of view. What else do we need to think about?
I think at the end of the day, you must have a will set up. Yeah, I mean, that's important because if I purchase a second property and I'm not buying it under trust because I'm not rich enough to buy a property fully in cash, and I buy a second property today, if I'm going to leave it for my kids, number one, I need to make sure that I have a will set up.
Oh, yeah.
Yeah, because if I don't have a will, then, the
It all
property
goes to waste.
it gets distributed to people who I may not have the intent to, in the first place, have them have the property. So have a will set up. Most importantly as well, I think get insurance. If you buy a second property and, halfway through you meet up with a life-changing accident or worst case scenario, you're no longer on the face of the planet, what's going to happen to the mortgage, right? If your kid inherits the property with the mortgage, that's going to be an issue as well. So a lot of people tend to forget this. And I've seen many cases like that too, where, owners buy a second property with the intent to, when my kids grow older, I will eventually give them the property, have them transfer under the name if they want to sell it it's up
Do
to
what
them.
they will with it.
Yeah.
Yeah.
But sometimes sad cases, I've seen them quite a few, where the main sole breadwinner passes on, right? The property gets willed down
Yep.
to, for example, like the spouse in this instance, for example, but the spouse is not working.
Yeah.
And there's a mortgage on the property
Still, yeah.
and there's no insurance.
Oh dear.
So the wife is left burdened in this case with a second property. I mean, of course, you can sell it off, but in the meantime, if you fail to meet the payments,
Yeah. I mean, the mortgage is still running.
Exactly.
You don't sell a house overnight.
Exactly. So if you want to think of inheritance, you've probably got to think holistically, get a will set up, ensure that you have insurance, right? So all these things are not like, buying a property, real estate. We just talk about real estate. You really have to think about the whole picture when you're planning for if you're leaving a property to your kids.
No, that's fantastic advice.
Yeah.
It's very easy to get caught up in the moment
Yeah.
of, hey, okay, here's my windfall. I'm going to go invest in this second piece of property. Let's go buy one. And then
Yeah.
you don't think about the longer term impact
Yeah.
of what that's going to be like when you pass it on. What kind of property specifically should we be looking at for investment versus a second home?
I
To
think
love
it's-
and to have and to
Yeah.
hold, really.
I think it's really different kind of requirements, because if you're looking at purchasing a home, you need to look at, do I like the view? Do I like my neighbors?
Is
Do I
it
like the
convenient?
community? Yeah, it's the development, like some developments, a lot of expats are attracted to certain developments.
Mm-hmm.
Oh, and I like that view, Is it convenient to the bus stops and the MRT stations?
Mm-hmm.
But when you're buying a property for investment, primarily you're just looking at the numbers as well.
Right.
Is it easy to rent out? How many rentals are there in a year? If I lose my tenant today, how fast am I able to find another tenant, for
The
example?
replacement rate, yeah.
Yeah. Is it going to be, of course, if you're near an MRT, good, because, if you sell it, chances are you sell it at a slightly nicer price. But the considerations are quite different. You're primarily looking at the numbers, right? To decide whether you would move into that particular development or not. Whether it's ability to basically appreciate in capital. Whereas, like I said, if you're buying a home, you may just like it, but 10 years down the road, you may not make a lot of money.
Yeah.
Yeah,
I mean,
so-
I think if you're going in with the objective of living there, then it shouldn't bother you too much.
Well, Singaporeans, when we always ask this question,
We're too pragmatic for our own good, I
we'll
tell
be like,
you.
you're buying your own home. Yes, but I also like to have it as a good investment.
You cannot have your cake and eat it all the time.
I mean, are there properties like that meet the requirements of you calling it a home and also having it a good investment? Yeah, I mean, there are some properties like that
Yeah.
as well. But yeah, generally, if you're looking like an investment property, chances are, unless the requirements coincide with that property, then great. But otherwise,
Yeah.
the requirements the properties you're going to get are quite different.
Sure. Okay. Right. So if the second property is then a piece of investment purely versus a second home, should we think about an exit plan? You talked
course.
about this in terms of
Yes.
asset disposal, right?
Yes,
So what
yes.
should this exit plan look like?
Yes, it's an important point that you just brought up. A lot of people purchase a property not knowing when to exit, right? They may have like a vague plan, like, okay, I think, but they always say, okay, Clive, whenever it hits this value, I'll just sell it. Right, so simple. But thinking, we have to think deeper than that. We have to come up with our cash flow as well, because now, along the way, let's say you buy a property and the kind of rental that you're getting is not fantastic, and interest rates right now in the market are quite high. You have to fork out quite a bit of cash.
Yeah.
So all these are expenses, right? And if you sell the property 5 years later at a certain price, let's say at a 10% gain, 20% gain, if you do the math, you may not get a lot of returns at the end of the day.
Right.
So it's important to, at the get-go, plan, okay, if I buy this property, have my cash flow ready. What kind of expected rental am I going to get?
Yes.
What is my maintenance fee? What is my property taxes, especially property taxes, because they're going to
Basically,
increase.
what your outflows are.
Exactly. Consider all your outflows,
Right.
factor them into part of the expenses, and then you plan, okay, if I exit after 5 years, what is a realistic amount that I can sell my property at
Yes.
based on current trends? So, okay, let's do a 2 or 3 or maybe 4% appreciation per year, and we sell it after 5 years at this price.
Yep.
Work the numbers out, plan ahead and say, okay, if I sell it at this price, what kind of returns am I going to get? A lot of people fail to do this. Everyone is just drawn into the hype of, it's a new launch, sure, make money.
Yeah, exactly.
Buy first, because everyone is buying. I can't get a queue number. I better just...
FOMO.
Exactly, FOMO. But not all new launches do well, right?
As we've seen in the headlines.
And you may not, at the end of the day, make money from this investment if you haven't really done the numbers.
No, you're absolutely right. You're hitting the nail on the head right there.
Yes.
So we talked about decoupling earlier, and I loved your explanation of decoupling. So now I read that a factor to consider when it comes to decoupling, and of course before you go ahead and buy that second property, is the type of holding or the type of tenancy. Okay, help me understand this.
Wait. Okay, so we call this the manner of holding. Now, basically, let's say you're buying a property with your spouse or a friend. Okay, so at least two parties involved. You can buy the property under two different ways. You can buy it under joint tenancy.
Yes.
Or you can buy it under this thing called a tenancy in common. Okay.
Got it.
So now, let's assume me and my wife, we purchase a property and we hold it in joint tenancy. So joint tenancy just means we own equal shares.
Sure.
Now, the deeper meaning behind a joint tenancy is if I pass away, my shares automatically go to my wife.
Yes.
Right? She inherits the property. It's a rule of survivorship. Now, there is another way of holding it, which is in tenancy in common. And tenancy in common allows us to alter the percentage that we hold in the property. Can it still be 50-50? Of course it can. So I can hold the property in a tenancy in common, 50% with my wife and 50% myself.
Okay.
And what happens if I pass away? If I pass away, my shares get distributed according to my will.
Got it.
It doesn't automatically go to my wife.
Right.
Now, that's one thing. The second thing that usually people talk about when it comes to manner of holding, more commonly heard as 99-1, this term. What is this entire 99-1
I read
thing
about that.
Exactly.
Demystify this for me, please.
Okay, so here it goes. I own the property with my wife in equal shares. The property is worth $1 million today. Now, I want to perform a decoupling where I buy my wife's share so that my wife can buy another property. And being the first property, that she doesn't have to pay for an additional buyer's stamp duty. That's my intent.
Yes.
So now I buy over my wife's share. My wife owns 50% of the share, so that's 500K, right? I have to pay for buyer's stamp duty on 500K.
Yes.
Okay? So, what's the other scenario? If I own the property in 99% and my wife owns 1%, I buy over my wife's share, 1% of $1 million is $10,000.
Oh, much more affordable than $500,000.
When I buy that $10,000, I'll pay buyer's stamp duty on $10,000, which is $100.
Oh, that's genius.
As compared to paying a buyer's stamp duty on that 500K, which is like $9,600.
Right.
So I save some monies in that buyer's stamp duty, right? So that's the reason why you go about and like everyone is telling you, hey, 99-1, 99-1. It's efficient in that manner.
Okay.
Because you save a lot on buyer's stamp duty.
That's correct.
Right? But there's some downsides to it.
I was
that people
sensing a but, yes.
They often don't consider. Now, let's assume this. My wife owns 1% of the property, and she has used CPF on the property as well. Let's assume that she has used $250,000 of CPF. When she sells her share to me, she has to refund that $250,000 back to CPF, right? How is she going to do that refund?
Exactly.
She has to come out with cash from her pocket, put it back into CPF. And when the moment comes where the couple realizes that, okay, I've saved on buyer's stamp duty, but now I have to fork out $250,000 and put it back in the CPF, where am I going to get the money from?
Which we completely forgot to think about.
Exactly.
Okay.
So if you don't have the means, or sometimes people say, I do have that $250K, but it's supposed to be used for the deposit on my new property. And now if I put it back in the CPF, where do I get the cash then?
2 steps forward, 1 step back.
Exactly.
Okay.
So it has to be considered. And it's not always the case that a couple would go for a 99%, 1% ownership. It might be varying like 70-30. And there's some reasons behind that. But yeah, just to break down simply what this manner of holding is about and how it's actually utilized.
I think that's exactly it. And then there's so many strategies to think about this when you're doing the 99-1, 70-30. You calculate what you have in hand and what you're going to get in the future. But the most important thing is how you're going to finance it right at the get-go without overstretching yourself, really. Because like we've been talking about, you know, it's great to think about the future, to think about, okay, this is what I'm going to get out of it. but what's the now?
Yeah.
What can you afford now? Because that's going to be able to stretch you into the decades as you get older.
Yeah. It's a very common thing that you brought up, Andrea, that people really, they think of the now, like, okay, I have money now, let's do this and let's hold it in 99-1 in the hopes of getting a second property. But they don't think of like down the road, eligibility. If I'm going to buy over my wife's share, can my wife afford, based on eligibility, the new property? Oh, we haven't thought about it yet.
Ooh,
So
let's
it's,
not make that painful mistake and all the other mistakes that you noted. So buying a property in Singapore, it sounds complicated, right? But if the time is right, if you time it right, and you've done your calculations well, as Clive has pointed out, that asset could serve you and your family well in the long run. Thanks once again, Clive, for walking us through the considerations.
You're most welcome, Andrea.
It was great to have you on the show.
Thanks for having me.
And thank you to you, our listener. If you've enjoyed this episode of Money Talks, there is always more content for you to enjoy. Just follow us on Apple Podcasts or Spotify. Give us 5 stars. Don't forget to leave a review. The team behind Money Talks is Jacqueline Chan, Joanne Chan, Tiffany Ang, Crispina Robert, Saya Wint, Jesselyn Tan, and I'm Andrea Heng.